Welcome back everyone. So some of you guys asked me to do an analysis on Doximity, so here we are today. Basically you can see that the stock price declined by about 60% in a year. So what the company does is basically it's a platform where medical professionals do networking between themselves. Alright, so as you guys know, the first thing I like to look at is the revenue and the operating cash flow growth and to see if they're consistent together. Last year revenue increased by about 66% and operating cash flow increased by 54%. So the growth is there, it's growing rapidly. The problem here is that we only have so much data. We only have data going back to 2019. So in that sense, we don't have too much data historically. So just keep that in mind. But so far, the growth is consistent. All right, so the second thing we always look at is how profitable is the business. We can see that the gross margin is at almost 90%, 33% for the operating margin, 43% for net margin, almost 30% free cash flow margin, which is pretty good, and a good cash conversion. This is the same thing here for the returns. Return on invested capital, 23%, return on equity, 20%, and a good return on assets of 18%. So the company is getting back good returns on the investments that they are making. And the profitability is pretty good as well. Let's now look at the financial health of the company. So first thing, we can see that the current ratio is at 8, so it doesn't seem like the company has any short-term financial distress. The second thing is that the company is debt-free, and I love to see this in the balance sheet. Two reasons. The first one is if a company doesn't have debt, it can't go bankrupt. And the second reason is because not having debt means that the company still has the option to take on debt in order to finance some projects and generate more growth for the company. So these are good reasons why I love having debt-free company. Here we can see that intangibles as a percentage of total assets at only 2.70%, which means that most of the asset that the company owns is physical and tangible, which is good. Now here we can see that they're heavily diluting their shareholders by increasing their number of shares. This is the biggest red flags I've found about this company. It's the dilution. The second point here is that they have a total cash of $800 million and zero debt. This looks amazing when you look at it. But remember, when a company increases their number of shares, they're selling shares to the market. Okay, by doing so, they're increasing their cash position. So in this $800 million, a big chunk of it is coming from that dilution and not the operations of the company. So just something to keep in mind before just jumping into conclusion that, wow, it's great. Alright, so here we look at the income statement. You can see the diluted average number of shares in mid-year of 2021. It was at 114,000 shares. And in the last quarter, we're at 215,000 shares. This is nearly an 87% increase in number of shares. And this is in barely 1 year. This is a really big dilution that the company is doing. Now, I know I keep repeating this, but dilution really is killing your return, so it's really important. In the left, you can see there's a $15 profit. And your share of the profits in this case would be $5. Now, if the company starts diluting and there's now 6 shares, your part of the profits is only $2.50. So there is a real impact of dilution. So as always, this is the kind of analysis that we do in this channel. We focus on the fundamentals of the company to try to find value in the current markets. If this is something that interests you, feel free to subscribe to support the channel. Let's now look at the financial outlook that the company gave away in their last earnings report. It says Doximity is updating guidance for its fiscal year ending March 31, 2023. The company is basically expecting revenue between 454 million to 458 million and an adjusted EBITDA between 192 million and 196 million. Now, if you look at the guidance they're giving us, this would mean that they're expecting the revenue to increase of about 32% and 33% and the EBITDA between 62 to 65%. These are big high growth rates, and I think this is why we can see a PE and the price to free cash flow that are high, because it's reflecting this growth. Now remember, this price to free cash flow of 51 and the price to free cash flow of 65 is after the stock price decreased of 60% already, and these are still high. Now the question is, at these valuations, is this growth justifying the price that we should pay for the stock? Or are we paying too much if we buy it right now? Alright, so as always, I like to have my discount rate at 12%. Some people might prefer 10%, but I prefer to have the margin of safety. We're looking at long term, so 10 years horizon. Now for the free cash flow, we can see that the last year it increased of 54%. Now you have to keep in mind that a company can't keep up with that kind of free cash flow growth for the next 10 years. It's just not realistic for us to put those assumptions. So realistically, I'm going to go conservative, and the goal is that the company hits realistic assumptions. Otherwise, you could put really high assumptions and you can get results that says that your company is currently undervalued, but that's not the goal, right? So let's go conservative and let's go with 12, 14, and 16% free cash flow growth. For the price of free cash flow, let's go 15, 17, 19. Now, as you guys know, the company is diluting their shares, but For this case, let's assume they're not going to dilute for the next 10 years, which in my opinion is a bit optimistic, but let's go with those. All right, let's now see. First of all, they're all red, so the company does look overpriced at these valuations. So if you believe these assumptions, even for the highest end, the company does look overvalued of about almost 60%. In my opinion, I wouldn't go buy the company at these prices. If you believe higher growth rates, for example, 25% growth rate with a 25 PE, then for you, it might be undervalued. But like I said, I'd rather go conservative with my assumptions, and for my opinion, it is still overpriced. All right, let's now do a quick recap. So we saw that the revenue is growing at a fast rate. This is good. The profitability is there. The company has good margins, which is good as well. Financial health, the company has zero debt. We love it. The big problem is that there's big dilution, and it's a heavy dilution, so it's really bad for the shareholders. This being said, I looked up a little more and I saw that the company agreed for a stock repurchase program of $70 million in 2023. This is not enough yet, but this could help for the dilution problem of the company. And is the company's valuation cheap? I don't think so, not at this time. And with the P of 51, the price to free cash flow of 65, and with the assumptions that we took on earlier. Nevertheless, the company still looks okay if you don't take into account the dilution and if the stock repurchase programs keeps on going. So I will add this to my wish list and see where this company is going. That was it for Doximity, guys. If you enjoyed this video, feel free to subscribe to support the channel. If you have any other stock that you want me to analyze, please write it down in the comments, and I'll see you on the next one.